don't know? You tell me. If something's happened the same way every time and we're doing the same thing, do you really think it's going to be different this time? Because I don't. So if you position properly, just based upon those historic patterns, then you are more than likely to be in the right place at the right time with the right asset. And what you're in is the most liquid assets on the planet because they run absolutely no counterparty risk and they're used in every single sector. I mean, it is really that simple. That's why you see global central banks. Not only are they buying more gold than they ever have in history, but they're repatriating their gold and bringing it home. Because what do they know? If you don't hold it, you don't own it. What is going to happen when the government debt market implodes is there will be a spike in interest rates, right? We saw that in 2019 when the money market funds were imploding at that point, the reverse repo market and the repo markets, and that, so we know what's going to happen. You're going to get a huge spike in interest rates. Now, will you be able to get your money out without a loss? The answer is no. And remember, they've done a lot since 2008 when the prime money market froze. They've done a lot of work to modify those contracts in those money markets and put up what they call gates, which is really, frankly, your inability to access them, as well as large enough fees. And as they were putting all of these new terms together, what their question is how big does this have to be to have people choose not to withdraw their money? So the first part would be the fees. No, you're gonna get a loss because when interest rates spike, the market value of the bonds go down. Now, if this is a shorter term, if this is when a bond is issued and there are shorter term bonds inside of that money market fund, inside of that, right? It's not going to move as much as, say, the 30-year bond, the longer bond. You can see that, right? But the other part of it is the fees that they're going to charge you and the gates, your ability to actually remove the funds. So I wouldn't have any more in there than you feel like you absolutely need to have in there, even in the treasury market, especially with what's happening in the treasury, in the global treasury market, with the lack of liquidity at, frankly, well, maybe not quite all maturities yet, but there is a breakdown that has been occurring since 2015. So this isn't something we're waiting for. This is something that keeps rearing its ugly head. Well, you guys know I love George Gammon. He's a very dear friend, and I think very highly of him. I don't get to go behind the scenes in there, but what we're really seeing is that they've got to, when the banks imploded in March and April of last year, the regional banks, they covered it up really quickly, and that they haven't finished. That issue is not over yet. So what's happening is, I don't care what size bank you are, including the central banks, right? Again, it goes back to this. With the interest rate spike, then the value of the bonds that they're holding, the market value has gone down substantially. So what they've done is they've made the changes so that the banks don't have to declare these losses. They can say, well, we're going to hold them to maturity and therefore there's no loss. I mean, there actually is a huge loss, but at least on a nominal basis, they don't have to show that loss.
When I hear people ask, do you really think it's going to be different this time? I can't help but reflect on the past. Historically, whenever we see massive debt bubbles, financial mismanagement, or unchecked government spending, it always ends the same way, with a crisis. Every time the same actions are taken, every time the same mistakes are made, the result is inevitable. So why would this time be any different? Looking at the historical patterns of economic collapse, debt crises, and currency devaluation, it's clear that we are heading toward another significant financial reckoning. The same warning signs are flashing now as they did before the Great Depression, the 1970s stagflation, and the 2008 financial crisis. But for some reason, many people believe that this time will be an exception. Why? Because they have a misplaced trust in a system that has been failing for decades. As I always say, the key to surviving and thriving during a financial collapse is to position yourself properly. This means understanding the patterns and preparing with the right assets that have stood the test of time. And what are those assets? Gold and silver. There's a reason why they're known as the ultimate safe havens. They are the most liquid assets on the planet, they have zero counterparty risk, and they're used across every industry and sector, from electronics to medicine, energy, and defense. It's really that simple. You don't have to overcomplicate things. Just look at what the central banks are doing. These are the institutions that have the most knowledge and access to data, and they are buying more gold than ever before. They're not just buying it, they're repatriating it, bringing it home. When central banks start hoarding gold and pulling it out of foreign depositories, it's time to pay attention. Why? Because they know something that the average person doesn't. If you don't hold it, you don't own it. Central banks understand that when the government debt market collapses, and it's only a matter of time, there will be a massive spike in interest rates. We saw a preview of this in 2009 when the money markets were imploding. Interest rates surged, causing massive losses across the board. When this happens again, and it will, the value of bonds will plummet. Anyone holding bonds or debt instruments will see their wealth evaporate. But that's not all. Since 2008, financial institutions have been quietly modifying the rules around money market funds, putting in place mechanisms like gates and fees that make it harder for people to withdraw their money during a crisis. So when the next financial collapse happens, not only will people lose money due to falling bond prices, but they will also face restrictions and penalties when trying to access their own funds. You might think, well, I'll just keep my money in short-term bonds or the treasury market. But even these supposedly safe assets aren't immune to what's coming. The global treasury market has been showing signs of strain since 2015. Liquidity is drying up and the cracks are widening. So if you have money tied up in treasuries or any kind of debt instrument, you're taking on significant risk. The banking crisis that hit in March and April of last year isn't over. In fact, it was just the tip of the iceberg. The regional banks that collapsed were quietly bailed out by the Fed and the Treasury, but the underlying issues haven't been resolved. What's happening now is that all banks, from the smallest regional banks to the central banks, are sitting on massive unrealized losses. These losses stem from the bonds they hold. When interest rates rise, the value of those bonds falls. And while the banks aren't declaring these losses yet, thanks to accounting tricks like holding bonds to maturity, the losses are still there. It's all a game of smoke and mirrors designed to make things look more stable than they really are. Take JP Morgan Chase, for example. They reported record profits last year, but when you dig deeper, you realize those profits don't make up for the massive losses they're sitting on due to their bond holdings. It's all a facade, propped up by clever accounting and financial engineering, but eventually the chickens will come home to roost.
So what's really most likely happening behind the scenes are rule changes to make things appear like they're okay and solvent. I mean, look at Jamie Dimon, look at Chase Bank, right? Had a phenomenal year. Of course, was it so phenomenal that it makes up for all of these massive losses? No, not really. The other thing that I want you to keep in mind, because I just pulled this not that long ago, but the most current diff balance, so that's the balance that the FDIC has to bail out depositors, is lower than it was when they couldn't do it last March and April. So all of those banks that were supposed to, oh, this is not going to cost you any money, the banks are going to reinvigorate and make deposits into that fund. Well, they haven't yet, right? It's at a lower level. So anything that you're holding in the banking system is subject to a run. They don't want you to know that, so they're going to do their best to keep things as hidden as possible. So I agree with George that there are definitely ongoing bank issues that we haven't seen yet. And I definitely also do believe that it's a central banker's job to support the banks, right? Not you and me. That's not their job. Their job is to support the banks. So yeah, just like what Powell went around the Treasury, went to Yellen so that it didn't show up on the deficits and on the Treasury balance sheet, and quietly borrowed the money to bail out the Silicon Valley Bank, etc. So gosh, are they doing that kind of stuff right now? Yes, they are. And on top of that are all the derivatives. The importance of the unrealized losses, those losses that we're talking about. And of course the banks don't want to talk about them. Why would they? They don't want you to know the truth. They don't want you to know that the most likely outcome in the future is for your wealth to get bailed in, either through hyperinflation or outright theft. Take your pick. If you don't hold it, you don't own it. You know, I'm running a business, right? So there is a certain level of cash, and you likely have some auto withdrawals and things like that because people set that up for convenience. So there's a certain level of cash that you do want to keep in the bank, but it is not more than what you feel comfortable losing, and you want to be properly diversified. So if you're keeping X amount of fiat dollars in the bank over here, you want to make sure that you have a certain level of gold over here. So if that goes away completely, well, you have the other that gets propped up, right? So it's a function of being diversified. You want to keep a minimum in there so that it can enable you to continue your current standard of living, those auto withdrawals. Maybe you have some auto deposits going in, etc. But for anything extra, personally, you do whatever you're comfortable with. But personally, I have a certain level of cash that is outside of the bank. And if I need to make a deposit, that's easy enough for me to do. So anything that I'm not willing to lose, I actually pull the physical cash out of the bank because that is my very first line of defense. Though even on that, it's at a certain level based upon how I have to run my business, etc., right? Beyond that, personally, food, water, energy, security, barterability, wealth preservation, community, and shelter. Aside from all of those mantra pieces, this is what I'm in because of where we are in the trend cycle and the fact that I've studied currencies and currency life cycles since 1987. Who do you know that has done that? And when you see these repeatable patterns, I can't guarantee what's going to happen tomorrow.
One thing to keep in mind is that the FDIC, the institution responsible for bailing out depositors in the event of a bank failure, is woefully underfunded. The FDIC's insurance fund is currently lower than it was when they couldn't cover bank failures last March and April. So if there's another banking crisis, and there will be, don't count on the FDIC to bail you out. What this means is that anything you have in the banking system is at risk. Whether it's checking accounts, savings accounts, or money market funds, it's all vulnerable to a bank run. And let me be clear, the banks don't want you to know this. They're doing everything they can to keep these issues hidden from the public. But the truth is, the system is fragile, and it's only a matter of time before it breaks. This is why I agree with George Gammon that the banking system is far from stable. The problems we saw last year with the regional banks haven't been resolved. They've just been papered over. The central banks are doing everything they can to support the banks, not the average person. Their job is to ensure the survival of the banking system, even if that means sacrificing the wealth of everyday depositors. We saw this in action with the quiet bailout of Silicon Valley Bank and other financial institutions. The Fed and Treasury worked behind the scenes to shore up these banks without it showing up on the official deficit numbers. They're doing the same thing now, just on a larger scale. But here's the thing, even the central banks can't stop what's coming. The losses tied to derivatives, the complex financial instruments that played a key role in the 2008 crisis, are staggering. And while the banks aren't talking about these losses, they are very real. The most likely outcome is that your wealth will be bailed in, either through hyperinflation or outright confiscation. Take your pick. So what can you do to protect yourself? The first thing you need to understand is that if you don't physically hold your assets, you don't truly own them. This is why I always advocate for holding physical gold and silver. These are real, tangible assets that have been a store of value for thousands of years. Sure, you might need to keep a certain amount of cash in the bank for day-to-day expenses, auto withdrawals, bill payments, etc. But beyond that, don't keep more in the bank than you're willing to lose. The banking system is built on a foundation of sand, and when the next financial crisis hits, your deposits could be at risk. Diversification is key. If you're holding a certain amount of fiat currency in the bank, make sure you're also holding a corresponding amount of gold. This way, if the fiat system collapses, and it's likely to, you'll have gold to fall back on. Personally, I keep a certain amount of cash outside the banking system. If I need to make a deposit, it's easy enough to do, but I don't trust the banks with the bulk of my wealth. Physical cash is my first line of defense. But beyond that, I'm invested in real assets: gold, silver, food, water, energy, and security. These are the things that will hold value when the paper money system collapses. I've been studying currency life cycles since 1987, and I've seen the same patterns play out over and over again. We are nearing the end of the current financial cycle, and the next crisis is going to be worse than anything we've seen before. One thing I've learned from studying history is that it always repeats itself. Whether it's the collapse of the Roman Empire, the hyperinflation in Weimar Germany, or the 2008 financial crisis, the patterns are the same. When governments overspend, when central banks create too much money, when debt levels become unsustainable, the system collapses. It's just a matter of time. So do I think this time will be different? No, I don't. But that doesn't mean you have to be a victim of the system. By positioning yourself properly, holding physical gold and silver, keeping cash outside the banking system, and diversifying into real assets, you can protect your wealth and your future. As I always say, if you don't hold it, you don't own it. The next financial crisis is coming, and those who are prepared will be the ones who come out on top. If there's one message I want to leave you with, it's this: prepare now. The warning signs are all around us, and the financial system is more fragile than ever. Whether it's a banking collapse, a currency crisis, or hyperinflation, something is going to break. And when it does, those who have prepared, those who hold physical gold and silver, will be in the best position to weather the storm. So ask yourself, do you want to be a victim of the system, or do you want to take control of your financial future? The choice is yours, but the time to act is now.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.